Welcome back, everyone. In this episode, we're going to be continuing on with our series on super investors. In the last episode, we went through 9 different super investors. If you missed that one, it's okay. Don't panic. There is a link in the pinned comment below. You can go back and watch it. This is going to be part 2. And we even added in some new additions to this series. For example, we're going to be looking at Brad Gerstner with Altimeter. He runs a massive fund, and he invests in companies that are these fast-paced, growing technology companies. Very interesting portfolio. He's had incredibly good performance, and I have a few of the same holdings he does. So I want to look at his views on these companies. We're also going to be looking at Mark Massey with Alta-Rock Partners. He manages around $4.5 billion. He's one of these investors that does not do any interviews. Nothing really said about him, not much online published about him, but he manages a ton of money and he has a very concentrated portfolio. Then we have people that we know about, Terry Smith, we have Josh Tarasoff, we have Mohnish Pabrai, going to be checking in on him. We have Pat Dorsey, the Morningstar moat guy. And then of course we have Nelson Peltz, who's currently in a big battle between him and Disney. He's trying to get on the board of Disney. We're going to be checking in on how that's going. So we have a whole list of these great super investors, and I think it'll be interesting to see what their portfolios look like, what they're buying and what they're selling. Maybe we can learn a thing or two from it. So I'm excited. Let's go ahead and jump in. Now, the first investor I want to introduce is a new one to this series called Brad Gerstner. You may recognize him because he makes frequent appearances on CNBC. He's also been a guest on the All In Pod. So he's been on that before. And he even has his own podcast now called the BG2 Podcast. Weird name for it, but I actually listen to it and I like it. And one of the things that you notice about Brad Gerstner is he comes onto TV, he talks about these really cool companies, Amazon, Google, AI companies. He's always talking about artificial intelligence. And you may just label him in the basket of investors that are excited about technology and just giving their input on it. That's what I thought when I first saw Brad Gerstner. Just another guy on TV talking about tech. But when I looked into him a little bit more, I realized that he's actually a pretty good investor. And he's been doing this for a long period of time. He started a fund a long time ago called Altimeter. Now, his fund's performance has been incredible. He's annualized at 29% since 2011. So this has been an incredible rapid growth in his fund's performance, in his assets under management. He's gotten a lot more recognition in the most recent years. Now, obviously, 2011 was a great time to start a technology-focused fund, so maybe there's a little luck there. But overall, that's still incredibly impressive performance that beats out the QQQ. So Brad Gerstner has been on a roll. He's had a lot of success, a lot of media attention. He manages a tremendous amount of money, around $19 billion in capital. And the way that you would describe his type of fund is one that's focused on fast-growing, innovative companies. Now, when I give that description, fast-growing, innovative technology companies, you probably think of ARK Invest, because Cathie Wood's ARK Invest has kind of branded her fund around innovation. But I've always thought that that's not accurate. I don't think that Cathie Wood invests in innovative companies. If we look at an example of this, I can show you Cathie Wood's holdings. Cathie Wood invests in companies like Coinbase. I don't consider Coinbase an innovative company. Not to really any big extent. Tesla is, but then she has Roku. She has UiPath, CRISPR, I guess those are innovative. But Block, Zoom, Roblox, these aren't the most innovative companies in the world. So even though Cathie Wood has successfully branded herself as the innovative investor, I believe a lot of the companies she holds are not really that innovative. Brad Gerstner, on the other hand, holds incredibly technology-focused, innovative companies, truly innovative companies. Now, before we jump into his portfolio, I just want to play one clip of him to just get an idea of who he is, the type of fund he runs, the type of thoughts he has on investing. This is him talking specifically about his position in Amazon.
Well, I give a tremendous amount of credit to Andy Jassy, Adam Selipsky, who runs AWS and the team over there. Remember, they're the market leader in cloud. We talk about them as somehow they're coming from behind. They've got a dominant retail business, which is going to benefit from AI. It's going to benefit through better targeting of ads, better targeting of merchandise. And I think that Jassy will continue to drive efficiency in that business. And then when you look at AWS, it's the market leader. A year ago, I was concerned, and some others were, whether or not Microsoft's early lead because of their partnership with OpenAI would cause a bunch of customers to leave Amazon and go to Azure in order to take advantage of the benefits of OpenAI. We didn't see that. We saw almost no customer churn. They signed the deal with Anthropic. Anthropic's on a tear. They're going to have models which are every bit as good, in the near term as ChatGPT 4 and 4.5 Turbo, et cetera. And so this is a great, healthy, competitive race in the landscape of models. Their customers, are continuing to voraciously move their data into Amazon, many of them putting it on Snowflake in Amazon or Snowflake in Azure, by the way. But that's what we see. Everybody standing up their data and then leveraging new AI workloads. Remember, at the end of the day, just telescope way out for a second. What is this AI business all about? Right? The founders of Snowflake said to me the other day, he said, when we got into this business, what we dreamed of was setting data free. And set the data free so that every company on the planet can make better decisions with their data. We're now leveraging machines rather than just humans to make better decisions with data. That's what AI is. Artificial intelligence is leveraging the power of machines, which can look at giant patterns within data to predict what is the best decision going forward, whether it's language, whether it's video, etc.
Now, that's a bit of a preview of the type of takes he has about technology. You may disagree or agree with him, but I think overall he has some pretty compelling thoughts about technology. And he's tried to use his portfolio to plug into the overall landscape that he sees evolving with technology. Now, his portfolio is not tracked on Dataroma, so we're going to whale wisdom here, but this shows the recent 13F filings and his current holdings. If we look at this, we can see that his very top holding that he's held, I believe since IPO, has been Snowflake, SNOW. This company is a very compelling company. I think it has a great long-term story. My issue with this company starting off was, even though I wanted to own it so bad, I just could not get past the valuation. It had such high expectations baked into it that I felt a little out of my comfort zone owning it. But Brad Gerstner and his team believes that Snowflake is going to be one of the biggest beneficiaries of the future, long term. Snowflake does a lot of things that have to do with data lakes, storing data, transforming it, making it useful. It is by and large a data company. And the more you research it, the more you realize it's a great product. Now, to illustrate the level of conviction they have with Snowflake, it currently makes up 41% of the portfolio. So it makes up a huge percentage, but it's actually going down in percentage because Snowflake has not been performing well since its IPO. If we look at it, and we go to all time here, Snowflake IPO'd in 2020. That's when they bought into it, I believe. So they're in the red a little bit. It's bounced around with a lot of volatility, but this has not dissuaded them at all. This hasn't discouraged them even a little bit. They have such a long-term thesis on this company. They're looking literally 10 years out, and they are just as convinced of the quality, the long-term value of this company. And even though Snowflake stock price has not performed well, the company has grown steadily over the past couple of years. So this is one company that I really do like. I've looked at Snowflake before. It's just the valuation that gets me. I think it's a little out there. One of the best bets that they recently did was they bought in heavily to Meta at the lows. That was such a fantastic call by them. They went in super low on the company. Obviously, Meta went up like 200%, so it was a great recovery play. That turned this to a 14% position. So even though Snowflake hasn't gone their way so far, Meta certainly did. Another one that they did really well on. This is another holding that was pre-cash flow positive, but they've made that jump to cash flow positive. Uber. This is a company where the CEO said, we need to generate cash and we need to do it now. They use their operating leverage, they cut down on costs, and they generated real cash. That's caused this company to be 13.6% of the portfolio. So their top three holdings make up like 60% of the portfolio: Snowflake, Meta, and Uber. But then we have other great names here. We have companies like Microsoft. This is an obvious one. Many super investors have it. They also have it as 10.3% of the portfolio. Their next biggest holding, which is 6%, is NVIDIA. And this is something I actually appreciate about this portfolio, is that they say they want to invest in innovative technology companies that are growing quickly, and they actually have NVIDIA in their portfolio. Obviously, they've done incredibly well on that over the past couple of years. That makes up roughly 7% of the portfolio. Now, NVIDIA might tank after earnings. It may have a difficult time, but they've already made such significant gains on this holding that it's unlikely to hurt them at this point. Then after NVIDIA, we have Confluent, another 5.7% position of a fast-growing, unprofitable cloud computing technology. So one thing that they're not afraid to do is to jump into companies that have historically been unprofitable if they can forecast out or model their profits in the future. So they believe these companies that are currently cash flow negative are going to generate significant cash flows in the future, just like Uber did. They believe that with Confluent. Now, we also have right here Amazon as a 3% position. I love Amazon right now, so obviously I agree with this holding. I hold it as well, but I like seeing Amazon in the portfolio. One thing that I notice when I'm looking at this portfolio is that it's missing Google. Have you noticed that? There's no Google in his portfolio, and he's invested in companies like Meta, Amazon, all these AI companies like Nvidia and Snowflake, but no Google. The reasons that he's not invested in Google is because he believes that large language models are going to take market share from search queries. He thinks that that's going to be a big part of search in the future and finding out information. And he thinks it's unlikely that Google is going to hold as big of a market share and monopoly on large language models as they did on traditional search. So he thinks that there's a major headwind for Google. That is the large language models, the ChatGPTs, the Perplexities, the Copilots. He thinks all of that is going to eat away at Google's long-standing dominant market share. I don't necessarily agree with him on that. I think that Google is likely going to be fine. I have reasons for that. But just note in his portfolio, that is a big omission. Overall, I really like Brad Gerstner. I like his thoughts. I don't agree with him on everything, but I think that he has real reasoning, real thought behind each of his holdings, and the performance speaks for itself. He's done great so far, so he's someone that I'm going to continue to follow in the series. Now, next up, we have another new investor to the series called Mark Massey, and he is from Alta Rock Partners. I became intrigued by him by looking at the portfolio and realizing how concentrated it is. He has $4.5 billion in assets under management in 8 positions. $4.5 billion in 8 positions is very, very concentrated. And his investing style, as he describes it, is wide moat investing. Now, because Mark Massey is new, I want to first look at a little bit of an interview to give you an idea of what he thinks about his investing philosophy. He says, "We think it's a very safe way to generate superior returns over the long term. Wide moat investing is just another way of saying that we try to buy at a rational price great businesses whose earnings are almost certainly to be much higher in 10 or 20 years. Great businesses, by definition, stand the test of time, and as a consequence, they're always compounding in value, like a savings account, but with a much higher yield, a much better yield." Now, he also goes on to give a distinction between traditional deep value investing and what they do. He says to me, deep value investing means buying a less than great business or a pile of assets trapped inside a corporation at hopefully a big discount to some estimate of intrinsic worth. My problem with this approach is that no matter how cheap you buy, time is working against you. In other words, your risk and return equation is highly dependent upon how quickly you can turn around and sell at a profit. With poor companies and cheap assets, the values can melt away while you're waiting for the market to see things your way. Buffett said it well, quote, "Time is the friend of a wonderful business and the enemy of the mediocre." So he's highlighting his distinction between deep value investing, buying these value traps, companies that are undervalued but are really poor quality, compared to buying really good companies that just compound over 10 or 20 years. He defines himself as an investor that's focusing on the higher quality companies. He has the 8 companies here, $4.5 billion in assets under management, and we can see the portfolio. Now, the first company, which is 27%, I have to admit is not one that I'm knowledgeable about. It's Transdigm. When I looked up this company, it's one that I feel out of my depth doing analysis on. It's one that I really don't understand. Apparently, this company incorporates, designs, produces, and supplies aircraft components in the United States and internationally. Mechanical and electromechanical actuators and controls. This is all stuff for airplanes. So I am not familiar with this industry at all, but I have to give him credit. Over the past couple of years, if we look at the past year when he went heavily into this, it's up 56%, beating out a lot of companies in the market, matching most of big tech. So this has been an incredible performer for the past year. And they own this company through that incredible rise in price. So obviously their research was really well done here. They had a successful holding. Now we also have Microsoft, Google, Amazon, Visa, Moody's, Charter, and MasterCard. And this seems like the crew of companies that you know and recognize. I love almost all of these companies. I don't own Charter, but I own most of these other companies because I think they're fantastic. His portfolio is a little bit different than other investors that focus on the wide moat companies. For example, he has no railroads, and he also has a lot into Amazon. This is one that I don't see a lot of super investors going into, so it's surprising to see 15% of his portfolio in Amazon. But so far, starting this off, we have both Brad Gerstner and we have Mark Massey with Altorock going into Amazon. Now, when I look at his trades for the past quarter, it's interesting to see that he trimmed most of his holdings. These are all ones that have done fantastic. And then he went big into Moody's Q4 of 2023, adding it as a 4% increase into his portfolio. And I like to buy into Moody's. I think it's an incredibly strong company. The only other company he added to was a little bit into Charter. Overall, Mark Massey has done really well with this portfolio. He's beat the market for an extended period of time. And I like the approach that he describes as heavily qualitative, understanding the long-term growth of these companies, the long-term wide moat of them, and just hanging on to a few companies that show their fundamentals, that prove it quarter after quarter that they're incredibly strong compounders. So I really like this portfolio. I think it's fantastic. Now, moving on, we have the super investor Terry Smith, who manages a ton of money, $22 billion. So he's really a large fund manager. Now, his strategy can be simplified, as he describes it, into 3 steps: buying good companies, not overpaying, and then doing nothing. But of course, that is a bit of a gross oversimplification of what he really does. He defines good companies as ones that have high ROCE, return on capital employed. That's a measurement that basically says how much money we get and the cost of it. What is the returns we get on that money? Are we profitable with the money we receive? Now, another measurement that's very similar is high returns on invested capital, or as Buffett says, high returns on tangible assets. No matter which one you use, they all basically measure the same thing. They're companies that are highly profitable with their business model. And they're most often found in companies that are capital light. So they make a lot of money without requiring a lot of capex. These are the type of companies that Terry Smith loves to have in his portfolio. Now, unlike Altorock, he is actually well diversified. His portfolio has 40 holdings. The largest position is Microsoft at 12%. So he's a bit more diversified than a lot of these super investors, but that's fine. He runs a massive portfolio. Now, if we look at the activity last quarter and we look at the change to his overall portfolio, I grade this quarter as basically no change. There's really no meaningful changes here. The biggest thing he did was sell a little Microsoft. He reduced his position size by 8.16%. Microsoft is now trading above $400 per share. I was pounding the table on this company when it was down to $220, $230. That was the time to really buy into Microsoft heavily, but now it's gone through this fantastic run through AI, Microsoft Copilot, Satya Nadella doing really good things on earnings calls and bumping up the earnings. So Microsoft has gone through a terrific run, and I think that Terry Smith is just shaving off a little bit on this position. I don't see anything wrong with that. Other than that, there was really no changes to the portfolio. He added a little bit to Fortinet. This is a very small position, 0.59% of the portfolio. He added a little bit to Clorox. He loves these type of consumer staple companies. And he reduced his Alphabet position ever so slightly. So not too many huge changes here. And overall, when I look at Terry Smith's portfolio, I see a group of companies that are above average. Most of them are either consumer staples or they're growth technology companies that have incredibly wide moats. It's a mixture of these types of companies, and he has outperformed the market with this strategy. And Terry Smith shows that you can still have good performance with a very diversified strategy. Now, next up, we have Josh Tarasoff, who manages around $300 million with the fund Greenlee Lane Capital. Now, Josh Tarasoff has an interesting background. He started his hedge fund in his bedroom. He had a computer at the end of his bed, and he just started a fund where he was trading stocks, started writing newsletters, and attracted assets. Now, one of the early companies he invested in was Amazon. He invested in it in 2006 and even a bit earlier than that. So obviously that was an amazing investment, and that's what grew his fund to size. It attracted more assets when he had that success. But recently, Josh Tarasoff has run into trouble. He held a lot of the companies that got completely crushed in 2021, and he didn't just have them as small positions. They made up the majority of his portfolio. This is Q4 of 2021, and he held top positions in Salesforce, Spotify, Amazon, Netflix, and Peloton, all of which went down dramatically in the following 2 years. So his portfolio got bruised heavily during 2021 and 2022, and I see that more recently he's trying to play things a bit more defensively. So when I look at his holdings right now, one of the new additions to the portfolio, surprisingly, has been Berkshire Hathaway. He bought into Berkshire in Q4 of 2023 as a major position, 12% of the portfolio. I see this as a defensive move. He was wounded. He got beat up in 2021. He's looking for something that just produces cash, resilient business model, super safe. Let's add Berkshire to the portfolio. When I look at Josh Tarasoff's portfolio, I don't have any issues with the actual holdings. I think these companies are fine. I like Amazon, I like Brookfield, I like Berkshire and Microsoft. There's no issues with these companies. What I have a problem with here, and I think the criticism that I'll give, is with the portfolio management. I think it's been far less than inspiring. Over the past couple of years, he went into 2021 completely unprepared. He got destroyed with a lot of his top companies being the biggest losers of 2021, 2022, going into 2023. But then the bigger mistake he did was he acted very reactionary. Instead of just doubling down on his companies and letting their long-term story play out, many of which would have just recovered in stock price, he sold them far too early. For example, if we look at his history, look at the last time he held Netflix. We can see it highlighted right here. He was big into Netflix in 2020, 2021, and then he sold Netflix in 2022. Right here is when he sold it, Q4 of 2022. So we have the past year without Netflix in the portfolio at all. But if we look at Netflix's performance over the past year, that was precisely the time to hold the stock. It is up 70% in the past year. So he held Netflix into the massive dip, but then he sold out of it before the massive rally. I think if you're going to invest in companies like Netflix and make them large positions, you have to have the wherewithal to hold them through massive volatility. Otherwise, you can have a jumbled approach that really hurts your gains over the past couple of years. So with Josh Tarasoff, I have not liked what I've seen over the past couple of years. I think the portfolio management has been subpar. Now, next up, we have Mohnish Pabrai. He's an investor that's all over social media. He's on Twitter, he's on YouTube, he does frequent interviews, he releases them for free on YouTube. And overall, I think Mohnish Pabrai is a great teacher. He shares interesting stories, he has interesting concepts on investing, but I think his portfolio is more than difficult to follow. It's one where I wouldn't recommend trying to replicate his strategy because it consistently changes strategies. He consistently changes themes of investing. He changes overall the direction he goes, and it's very difficult to keep a consistent look at what he's doing. For example, at one time period, he was investing in companies that he considered long-term compounding machines, companies that had strong moats and earnings growth for a long period of time. Now he's changed his strategy to coal companies, energy, which there's nothing wrong with that. In fact, I think a lot of these companies have done really well, but it's a dramatic change in strategy from one year to the next. And he will do this on a whim. He'll do this very quickly if he sees value. Ultimately, he would describe himself as a bottom-up fundamental analysis investor that looks for value, and he'll invest in any company he sees it. So he's generated good returns with these coal companies, but in terms of a consistent strategy that I think is somewhat easy to replicate or to try to reverse architect, this is certainly not one of them. Another thing I'll mention is Mohnish Pabrai holds a lot of holdings that are outside of the US, which Dataroma does not track. So these aren't his only 4 holdings. He owns different holdings from all different places. Last quarter, his biggest purchase was Arch Resources. This is another one of these energy companies. Now, this one has revenues that are a bit unpredictable. They're a little bit all over the place for the past 10 years. It has EBITDA that's all over the place. Like many of these energy companies, the cash flow is up really big one quarter or down in the red. We have net income that's all over the place. Everything looks a little bit jumbled, and that's why you can't rely on consistency with these type of companies. Now, I of course believe there's money to be made with coal companies. There's times where they produce a lot of cash, but you have to know when to get in and when to get out. The industry overall is a bit more cyclical, and I think a bit less predictable. For that reason, I don't invest in them, but it's interesting to see investors like Mohnish Pabrai go all in. Now, next up, we have Pat Dorsey. He's the moat guy from Morningstar. He's made that a bit of his branding. He understands moats really well. He's given lectures on moats. And his portfolio was another one that, similar to Josh Tarasoff, it got crushed in 2021. He owned a lot of companies like Wix as large positions that went down dramatically. The difference that I would mention with Pat Dorsey compared to Josh Tarasoff is I think he handled the downturn much better. He, instead of going defensive and buying companies like Berkshire, he's instead gone into companies that recovered really well over the past couple of years. He held on to Meta and he doubled down on Meta, which was a massive winner. So that made up for a lot of losses the previous years. He also continued to hold Wix, he continued to hold Google, he continued to hold these companies. Now, if we look at his activity from last quarter, his biggest purchase by far is Danaher Corp. Danaher Corporations designs, manufactures, and markets professional medical, industrial, and commercial products and services worldwide. So this is a medical device company, which are known to have resilient business models because hospitals are always buying this type of stuff. They rarely change clients. They just continue to reorder from the same companies. So this seems like a decent bet. The company's a 184 billion market cap, and it has a nice healthy 3% free cash flow yield. Other than that, what he did last quarter was a lot of selling. Now I want to note two fairly large positions that he sold his entire stake in. He exited these positions. First, we have Disney. Sold 100% of it. This was almost 7% of the portfolio. Then he sold Dollar General. 100% of the position gone. This was almost 4%. So he sold out of the two struggling companies. Dollar General, Walt Disney, both have struggling fundamentals. A lot of people are in these companies as recovery plays, low value plays. I think they have their place, but he's out of both of them. He wants companies that I think are a bit stronger. Overall, when I look at Pat Dorsey, I realize that his portfolio got hurt bad in 2021 to 2022. But the way that he handled the recovery was much better. He doubled down on Meta, and that was the best move he could have done. So he recovered a lot of the losses through that bet. But overall, when I look at his portfolio, there's some names that I like. I like Meta, I like Google, I like PayPal. But I'm not so sure about Wix or Herc or Danaher or Upwork. These are ones that I don't think are quite as strong. Pat Dorsey's still someone that I would not follow with my portfolio. Now next up we have Nelson Peltz. He's an activist investor that's been battling Disney for the better part of 2 years. He's trying to get positions on the board of Disney so that he can have some sway in the company. And his argument's pretty simple. He just points to the scoreboard. If we look at Disney, it is true the arguments that Nelson Peltz brings up. He says that they're not creating a lot of value for the shareholders. Now, this year, Disney's doing really well. It's up 21%. That's good for Disney shareholders. But if we zoom out a little bit, we go to the past 1 year, it's up 7%. It's not so great. We go to the past 5 years, down 3%. Then we even zoom all the way out to 10 years, 37%. And Disney doesn't pay some huge dividends, so this is not great returns for a decade. So Nelson Peltz is looking at the track record and saying, look guys, you're not creating value for the shareholder. You're not doing your job. You're underperforming the benchmark, the market, and other peer companies. Now the Disney board is saying, what do you know, Nelson Peltz, about media? You have no expertise. You're not going to improve anything in any way. We're the ones to figure this out. Now my opinion between this dispute is that even though Nelson Peltz isn't an expert in media, that's besides the point. Disney needs someone to be a very crucial, critical voice in their boardroom, to call out the mistakes they're making and their underperformance. What I don't like seeing with Disney is continually huge pay packages for the CEO, Bob Iger, while he underperforms the index for the past decade. I think that's unfair to the shareholder. And Nelson Peltz is one of the only ones to point this out. So even though the stock is up big over the past month, Nelson Peltz is still unhappy. He wants to be involved in the company. He wants to be a critical voice to be able to help the company improve. Now, one of the funny things that Nelson Peltz says when he was interviewed this month is, what does Treon want? Treon is the fund that Nelson Peltz runs. And he says fundamentally and crudely, we want the stock to go up. That's what Nelson Peltz wants. He wants this stock to actually perform well. So what he's trying to do is pressure the Disney team to really get their act together. Now, as this dispute plays out, just remember that companies that have strong fundamental performance, that are doing really well, they don't attract activist investors. Companies like Netflix have no activist investors. They don't need one. They're doing really well. So everyone's satisfied, cheering them on. Investors are happy. When you underperform the market for extended periods of time, you can't complain that the company attracts activist investors. So if Disney wants to make Nelson Peltz go away, the answer is very simple. Improve the fundamentals, make the stock price go up. If they're able to pull that off, then there's no need for Nelson Peltz. As of right now, he is committed to this bet. He has 41% of the portfolio in Disney alone. That is over $3 billion. So he's not just talking, he has a serious amount of money committed to this position. So there we have a look at 8 more super investors. I hope you enjoyed this series. If you like this type of content, make sure you hit the little bell notification so you get notifications of future uploads. You can also check out the Patreon. We have a fun community. We shoot the breeze, talk about stocks, and you get access to Qualtrim.com when you join. Other than that, see you in the next one.